What if I told you that one of the most ruthless, highly optimized, tech-driven operating systems in retail right now isn't a software company?
I'd say that's a pretty bold claim.
Right. But it's actually a company selling pieces of plastic and glass for your face.
Yeah, it's fascinating.
Because if you're listening to this, you've probably been to an optometrist. You know the drill. It's this slow, highly clinical process. It honestly feels almost like going to the dentist, you know?
Oh, absolutely.
You sit in a waiting room, you pick from a wall of basically identical frames, and then you wait a week or more for some off-site lab to actually cut the glass.
Yeah, and that is the traditional optical retail model in a nutshell. And it's entirely built on friction. I mean, the traditional supply chain is incredibly fragmented.
Right.
You have a frame designer, a completely separate frame manufacturer, a third-party lens lab, and then finally, the actual retail storefront.
Too many cooks.
Exactly. Every single handoff adds time, and more importantly, it adds cost.
And it is deeply frustrating for the consumer. But today, we are taking a deep dive into a company that looked at all that friction and just decided to completely rewrite the rules of the industry. So, welcome to the Japan Stock Podcast.
Great to be here.
Our mission for today's deep dive is unpacking the financial engine and the strategic DNA of JINS Holdings. We've got a massive stack of data on the table for you today, ranging from their Q1 financials to regional sales breakdowns and management's master plan for 2025 and 2026.
And to truly understand JNS, we really have to look past the physical storefronts. If we dig into the technical definition of their business, their true identity is a vertically integrated global SPA model for eyewear.
SPA model.
Yeah, SPA stands for Specialty Store Retailer of Private Label Apparel, or, well, in this case, accessories.
Okay, let me translate that into a real-world analogy for you listening. Don't think of JNS as a traditional glasses shop. Think of them more like the fast fashion techwear of your eyes.
I like that.
Right, because they took that slow, expensive, traditional optician model we just talked about and turned it into an agile, tech-driven platform. It's essentially an operating system for your face.
It really is.
You walk in and you get custom, high-tech lenses with AI diagnostics that perfectly match your facial structure, and they hand it over to you in just 30 minutes.
And that 30-minute turnaround,
Wow.
that is a massive paradigm shift. But to appreciate how that unique identity actually generates revenue, we need to examine the virtual battle they are fighting in what is just a brutal retail market.
Oh, retail is rough right now.
It's ruthless. So let's frame the industry rivalry here.
Yeah.
In the optical space, you essentially have two paths. Path B is what the traditional optical retailers are doing. They compete by selling basic frames as commodities.
Which is a pretty dangerous game, right? Because if your frames are just basic molded plastic, some competitor down the street or, a new online retailer can always manufacture them for $1 cheaper.
Exactly.
It just becomes this relentless race to the bottom on price.
Right, and the margins completely evaporate. So JINS chose Cafe. Instead of racing to the bottom on the basic frame, they focus intensely on high-value added options.
Okay, like what?
We are talking about ultra-thin lenses, UV-cut lenses, visible light photochromic lenses that actually change tint based on the ambient lighting.
Oh, wow.
Yeah, and they're JINS screen lenses that filter out blue light.
But securing that path A wasn't exactly a straight line for them, was it? Looking at their historical strategy, there is this fascinating drama of adaptation. They basically had to turn their scars into armor.
Yeah, and management has actually been quite open about this historical vulnerability. JINS have a long track record of creating massive, industry-defining hits.
Right, like their airframe line.
Exactly. Airframe was revolutionary for its lightweight flexibility, and their JINS screen product practically invented the blue light blocking category for the masses. But here's the problem with relying on a hit product.
They get copied.
Yep. In a fiercely competitive market, physical innovations get copied. Fast followers just reverse engineer the frames, the products quickly become commoditized, and then JNS's competitive edge just erodes.
Right, so their biggest strength, which is this product innovation, just kept getting neutralized by competitors waiting to copy their homework. That is a deep operational scar. So how do you actually build armor against that?
Well, you build a relentless compounding product development cycle. Management realized a static hit product just isn't enough anymore, so they introduced lines like JNS 360 degrees, which engineers this extreme multi-directional durability.
Okay.
And JINS Home, which are frames specifically designed to not dig into your face when you're lounging on a pillow.
That's actually brilliant.
But the real impenetrable armor, that's their digital moat. As of November 2024, they boast 15.64 million GNS app members, and they are leveraging proprietary AI for lens diagnostics to match frames to individual user data.
Wait, I have to challenge you on this because I hear app members and AI diagnostics and, it sounds great on a pitch deck, but let's be real. At the end of the day, isn't a pair of glasses ultimately just a piece of plastic and glass? No matter how many app members you have, how deep is that economic moat, really?
I hear you.
If a competitor undercuts them by $20, won't consumers just jump ship?
That's the logical assumption,
Yeah.
yeah. But it misses the hidden financial mechanics of their SPA model. The economic moat isn't the physical plastic frame. The moat is the high margin attachment rate.
Okay, unpack that for me.
Let me break down how this works.
Uh-
Because JINS controls the entire supply chain, from the factory floor all the way to the storefront, when a salesperson upsells you a photochromic lens upgrade, the margin on that upgrade isn't being split with a third-party lens manufacturer
Oh, right.
or a separate distribution lab. JNS captures the entire premium. Furthermore, that 30-minute delivery speed we talked about. You cannot replicate that without a completely integrated, optimized supply chain. A competitor might make a cheaper frame, sure, but they absolutely cannot offer the high-margin tech upgrades, cut the lenses in-house, and hand the finished product to you before you finish your coffee.
Wow, okay.
That speed is an operational barrier to entry that takes years and billions of yen to build.
Okay, that makes a lot of sense. The speed itself is the product, and owning the supply chain lets them keep all the profit from those upgrades. So they have secured the domestic front in Japan with this model. But taking a highly calibrated system global, that's usually where retail models start to fracture.
Very true.
So how is this model surviving the friction points of the international market?
Well, the international expansion has definitely been the ultimate stress test. Let's start by looking at China because it perfectly illustrates their operational resilience. We've all seen the data regarding the severe macroeconomic sluggishness in China right now.
Right, and just for anyone listening who isn't steeped in macroeconomics, sluggishness essentially means consumer wallets are clamped shut.
Precisely.
When the broader economy slows down, discretionary spending is the first thing to die. People decide they can, live with their old scratched glasses for another year instead of buying a new pair.
And that is the exact environment JNS was facing. But instead of just waiting around hoping the market would magically improve, they pulled off a really remarkable structural reform. They aggressively identified and closed low-profit stores.
Really?
Yeah, early on, they shut down 7 locations entirely just to stop the cash bleed and completely restructured the regional business.
See, this is a masterclass in adaptation. They admitted defeat on bad real estate. They didn't fall for that sunk cost fallacy. The whole, we spent so much opening the store, we have to keep it alive mentality.
Right.
They cut the dead weight to save the regional engine. But how does closing down stores actually help the bottom line?
By eliminating those fixed costs, the rent, the utilities, the staffing for underperforming locations, they stopped the active destruction of capital. And then they could reallocate their inventory and focus their marketing spend entirely on high-performing hubs.
Ah, smart.
The result of that disciplined retreat was a complete return to profitability in the region. They got back into the black, and sales leapt to 12.26 billion JPY in the first half of fiscal year 2026.
That is wild.
To grow your revenue while simultaneously shrinking your physical footprint in a declining economy, that is incredibly difficult to execute.
It really is. So they proved they can maneuver out of a real estate trap in China. But what happens when the problem isn't real estate but currency? Because that brings us to Taiwan and Hong Kong.
This is a fascinating tale of two markets, and it is entirely driven by foreign exchange rates, or FX divergence. Taiwan right now is booming for JNS.
Okay.
The local economy is relatively strong, they are successfully expanding into rural areas, and their high-quality Japanese lenses are just highly popular as a premium option.
But Hong Kong is the exact opposite story, right? The data shows Hong Kong is seriously struggling. So why the sharp contrast between two neighboring markets?
Let me break down how FX divergence works here. It really comes down to outbound travel dynamics. Right now, we have an extremely weak Japanese yen. Combine that with Hong Kong's own domestic economic sluggishness.
Yide.
If you are a Hong Kong resident with disposable income, your money goes incredibly far in Japan right now. So instead of shopping locally, they are traveling. They are taking their capital to Japan or even mainland China and spending it there.
Wow.
This pulls consumer capital directly out of the Hong Kong retail sector. JINS is essentially losing a sale at their Hong Kong storefront, only to capture that exact same customer when they walk into a JINS store on vacation in Tokyo.
Wait, so they're basically cannibalizing their own Hong Kong stores because those customers are just flying to Tokyo.
Exactly.
But the problem is, JINS still has to pay the commercial rent for that empty Hong Kong store.
Yes, they do.
That is a perfect example of how macro currency trends actually hit the cash register. So they are managing currency shifts in Asia. What about the United States? Because that is notoriously a graveyard for Japanese retailers trying to cross the Pacific.
The U.S. remains a difficult, highly saturated market, but the numbers show they are finding stability. Existing store sales are steady. And more importantly, they opened a new pilot store recently in October 2025, and it has successfully helped shrink their operating deficit in the region.
Okay, good.
They're focusing heavily on improving store-level profitability, really testing what works in the American market before attempting any massive, risky expansion.
Okay, so we see the global footprint shifting. They're putting out fires in Hong Kong, restructuring profitably in China, and finding this cautious foothold in the U.S. The obvious question is, what does this all mean for the engine room? How are these operational adjustments actually translating into hard numbers for the shareholder back home?
The numbers coming out of the domestic market are just truly staggering. Let's look at the Q1 domestic results. Domestic sales hit 16.04 billion JPY.
Okay.
That is a very solid 19% increase year over year. But here is the critical metric you need to pay attention to. Operating profits skyrocketed by 97.6% year over year.
Almost 100%.
Yep, hitting 1.69 billion JPY. And if we zoom out to the full year for FY 2025, existing store sales grew by a massive 16.5%.
I really want you listening to visualize what a 97.6% profit jump actually means, because it is wild. They did not achieve this by simply selling twice as many pairs of glasses. You can't just magically double the amount of foot traffic walking into a mall overnight.
No, you can't.
They essentially put their profit engine on steroids by convincing their existing customers to upgrade their trim level.
The data bears out that exact analogy.
It's like walking into a car dealership. You go in planning to buy the base model with cloth seats. But the salesperson is good, and you leave with the leather seats, the premium sound system, the sunroof. The physical footprint of the car is exactly the same, but the profit margin for the dealer just went through the roof. That is what JINS did. By successfully upselling those high-margin options, the ultra-thin lathes, the photochromic tint on the exact same physical frames, their profit margins just exploded.
Exactly.
They didn't need to double their customers. They just maximized the value of the customers already standing at the register.
And we have to ask why that margin explosion is happening right now. It is being driven by what management identifies as a triple tailwind.
Okay, let's hear them.
First, domestic inflation. In an inflationary environment, JINS discovered they actually possess pricing power. Consumers are willing to pay a premium for perceived value and durability. Second, favorable weather and the massive influx of inbound tourism. Remember that weak yen we discussed with Hong Kong?
Oh, right.
Is bringing waves of tourists directly to JINS stores in Japan while it's wide open.
And the third tailwind, because inflation and tourism, those are external.
Right. The third is deeply internal and operational. They significantly improved their store operations to maximize the number of glasses handed over per hour. This requires us to understand the concept of operating leverage.
Let's break it down.
Here is how operating leverage works. Your fixed costs, like the lease on the store and the base salary of your staff, they stay the same whether you sell 10 pairs of basic glasses or 10 pairs of heavily upgraded premium glasses.
Right. The landlord doesn't charge you more rent just because you sold a nicer lens.
Exactly.
Yeah.
So JINS has optimized the physical movements of their staff and the workflow of their lens cutting machines, just increasing their throughput capacity. When that massive wave of inbound tourists hit, the stores didn't choke on the volume.
They were ready.
They processed them efficiently. Because those fixed costs were already covered, every extra dollar of gross margin from a premium lens upgrade fell directly to the operating profit line. That is why revenue grew by 19%, but profit grew by nearly 98%.
That is the magic of operating leverage in a highly optimized system. So the engine is running red hot. The domestic market is generating massive amounts of cash. The next critical question for anyone analyzing this business is, what is management doing with the windfall?
And to find the truth of their capital allocation, we have to dissect the cash flow statement. Right now, operating cash flow is sitting at a very healthy 10.53 billion JPY. But investing cash flow is at a negative 7.86 billion JPY.
Okay, wait, a negative investing cash flow of almost 8 billion yen means they are spending heavily. They are not just hoarding this cash or handing it all back in dividends to the shareholders. Where is the money going?
Management is aggressively deploying capital into what they term strategic costs. And this breaks down into two main areas. First, they are establishing subsidiaries and planting flags in emerging markets. Vietnam in September 2024, the Philippines in August 2025, and they are moving into Mongolia.
So planting the seeds for the next decade of growth.
Yes, but the largest chunk of that capital is being deployed into major domestic real estate, specifically two massive architectural projects. They are building a 1,000 square meter JINS Shinjuku megastore slated to open in April 2026.
1,000 square meters.
Yes, and even more ambitious. A global flagship JINS Ginza store opening in spring 2026, located directly on the iconic Chudori Avenue.
Okay, wait, I have to push back here. Ginza's Chudori is quite literally one of the most expensive stretches of commercial real estate on the planet.
It is.
Dropping massive capital into a 1,000 square meter megastore and a Ginza flagship in the middle of global inflation. Let's be real, isn't that just a massive vanity project? Are they actually prioritizing shareholders with these investments, or is management just building architectural monuments to themselves?
I mean, it absolutely looks like a vanity project on the balance sheet. But strategically, it is a necessary step for TAM total addressable market expansion. JINS's stated corporate ambition is to become the world's #1 eyewear brand. To succeed with a global franchise model, especially when entering new markets like Vietnam or the Philippines, they have to project absolute, undeniable, premium brand equity.
Okay, I see where this is going.
Right. You cannot ask a global franchisee in Manila to invest millions of dollars into opening a JINS store if your brand doesn't command immense respect in its home market. By dominating Tokyo's most prestigious luxury districts alongside the world's biggest fashion houses, they're creating a global halo effect.
That makes total sense.
They are projecting to the international market that they are not just a discount fast fashion glasses shop, but a premier high-quality Japanese brand. That prime real estate is essentially a necessary global marketing expense disguised as a building lease.
So the Ginza store isn't really about selling glasses to the people walking around Ginza. It's a three-dimensional billboard for the entire global operation.
Precisely.
Okay, that makes sense. But taking a step back from the brilliant real estate strategy and the record profits, we can't just sit here and be cheerleaders. We have to look at the data critically. What is the blind spot here?
Well, professional prudence requires us to look closely at the vulnerabilities, and there is a very crucial blind spot in this current growth narrative. The incredible surge in operating profit we discussed is heavily reliant on two specific factors holding steady.
Okay.
First, it requires customers to willingly and consistently purchase those high-value added options, the photochromic and blue light lenses. And second, it requires the massive tailwind of inbound tourism, which is currently driven by a historically weak yen.
Right, both of which are external factors completely outside of management's control.
Yes, exactly. If global consumer spending tightens further due to resource price hikes or broader economic issues, that discretionary $50 upgrade to a premium lens is the very first thing a customer cuts. Furthermore, what if the yen dramatically strengthens? The tourists stop coming to Tokyo to shop. If that inbound volume drops, or if local consumers revert to buying basic frames to save money, Jagomari's operating leverage will violently swing the other way.
Wow.
High fixed costs for prime real estate in Ginza and Shinjuku suddenly become very heavy anvils around the company's neck when throughput volume drops.
It is the double-edged sword of operating leverage. It mathematically amplifies the wins on the way up, but it will absolutely magnify the losses on the way down.
Yep.
Which brings us to the ultimate question you have to ask yourself if you're analyzing this space. We've talked a lot about JNS owning their supply chain and setting this new 30-minute standard for optical retail. But if their ultimate goal is to be the world's #1 eyewear brand, what happens when they finally bump into the massive, entrenched global optical monopolies?
That's the real test.
Right. The multi-billion-dollar European conglomerates that literally manufacture the raw materials for those high-margin lenses. Right now, JINS controls the retail and the frame. But if they truly want to dominate the globe, will their SPA model hold up when the companies supplying their cutting-edge lens tech are also their fiercest international competitors?
It's a huge hurdle.
It's one thing to disrupt the slow local optician. It's an entirely different war to take on the global suppliers who own the raw science of vision.
And it's a defining geopolitical and supply chain question for their next phase of growth. I mean, they've built incredible armor for the domestic retail battle, but the global battlefield operates on an entirely different scale.
We'll be watching closely to see if that operating system for your face can scale globally or if it needs a fundamental software update. Thank you for joining us on this deep dive for the Japan Stock Podcast. We encourage you to keep questioning the hard numbers behind the brands you wear and see through every single day. Until next time.